What if I told you there was one cover call ETF that's starting to dominate the market, and most people aren't even talking about this. Most people are talking about QQQI, SPYI, or even JEPQ. Now this ETF today we are talking about is GPIQ, which is the Goldman Sachs Premium Income ETF. Hey guys, my name is Steve, and I run the Frugal Expat website where we try to help people to save more and invest better. Today we're talking about GPIQ, and a couple reasons we're talking about this is because it is one of the most underlooked, underrated cover call ETFs on the market, and it could be the best cover call ETF on the market. Let's get down to it and let's dive into some of those numbers, dive into why GPIQ is doing so well and how it compares to QQQI. All right, let's get to it. Now, GPIQ has a very interesting strategy when they're creating those cover calls. And first of all, when we're looking at some of these cover call ETFs, we got to take a look at, the yield. We got to take a look at their strategy. We got to take a look at maybe tax implications if this ETF is not in a Roth IRA. So one of the reasons GPIQ does so well is because unlike a lot of the other cover call ETFs, it only writes call options on its maybe 25 to 50% of its portfolio. So that means it is creating money based upon maybe about half of its portfolio and letting the other half go along with the market. When it writes these cover call options, they're writing cover calls at the money. So that means it's trying to create the most premium possible on that 25 to 50% of its portfolio, allowing the rest of it to kind of match the market. So if a bull run happens, it's not having such a capped upside when it's writing calls on anywhere between 75 to 80% of its portfolio. It's allowing there to be a little bit of some upside. Now that could be some good news to you guys if you're looking for some price appreciation and a good yield. Right now, GPIQ, since its inception in October 2023, has done a total return of about 56.56%. Now, year to date, right now, it's done about price appreciation about 2% with a total return of 10.42%. So this ETF is appreciating in price, and it's also bringing in a good yield of about 10% annually, which is paid out monthly to those shareholders. So what you're getting is you're getting a pretty good yield of about 10%. You're getting a good price appreciation, unlike some of the other ones. I mean, right now, JEPQ is down 2%. QQQI is up about 0.71%. And so you are seeing more price appreciation with GPIQ. Now, total return does matter. And when we're looking at total return, we're looking at dividends, we're looking at price appreciation, and we're looking to see if our money is growing and not kind of dipping down. And NAV erosion is a problem with a lot of these cover call ETFs. QYLD is down about 16% year to date, and that's crazy to think about. But it's one of those cover call ETFs that people have been buying. But right now we're looking at GPIQ. So let's look at the total return. So the total return since its inception in October of 2023 is 56.56%. In that same time period, JEPQ has done about 44%. Now, since the inception of QQI, the total return is about 32%. So we're looking at one ETF, GPIQ, that's doing much better than the other two big dogs on the market. Now, it's got about $1.28 billion in assets under management, and it continues to grow and grow. Now, with price appreciation alone, in year to date, it is up 2.06%. At the same time, QYLD is down 16.25%, and JEPQ is down about 2%, and that's in price appreciation. Now, QQQI is up about 0.71%. That's good news for those that hold QQQI. And if we look at the yield's sitting at about 10%. Now, it's not as good as QQQI, which has a yield of about 13.92%, but it does have a pretty good yield if you're looking for income and you're looking for some growth in the price. The other good thing is during market corrections like the one we had in April of 2025, GPIQ fell about 24.67%. And it rebounded to about 32.99% since that time period. So that is amazing news. If we're looking for some rebounding and we're looking for something that doesn't just crash and burn because the market crash and burns, GPIQ does that. Now, that's because of their strategy. They only sell cover calls on 25 to 50% of their portfolio, allowing the rest of the portfolio to get some of that upside when it happens. The Nasdaq 100 fell almost 20% in that market correction, but since then, QQQ is up about 11 to 15%. So if we wanted an ETF to kind of match those returns of the Nasdaq 100, GPIQ could be the ETF that you could hold in your income portfolio. Now, if we look at GPIQ versus QQQI, we can see that in total performance, total return of the year, GPIQ is up 10.42%. QQQI is up 10.82%. So QQQI is winning because of the higher yield. Now, if we look at the expense ratio, GPIQ is 0.29% for right now. It's going to be up at 0.35% later on, but they're giving a waiver fee. Now, QQQI is 0.68%. So if we're looking at the expense ratio, GPIQ is much better and it's going to compound over time. Now, the yield's going to look a little bit different. GPIQ has a yield of about 10%, while QQQI has a yield of about 13.92%. So if you're just looking for income alone, QQQI is the better one. Now, if you're looking for a little bit of growth and some of that income, GPIQ is probably the better bet. Now, we're looking for taxes because if you have this in a taxable account, taxes do matter. But if you have it in a Roth, it really doesn't matter because Roth, it'll be tax-free when you take it out. So GPIQ does 1256 option contracts, which means about 60% are going to be long-term capital gains, while 40% are going to be short-term capital gains. Now, QQQI does about a lot of ROC, as in August they did 100% ROC, which is return on capital. So if you paid for it, they're returning some of that capital back. GPIQ is not doing as much return of capital as compared to QQQI. And JEPQ does ELNs, which means all of their dividends and distributions are taxed as ordinary rates. So JEPQ is going to be taxed as ordinary rates, means it's less tax efficient than GPIQ. So we're looking at three different ways. We can put it all in Roth and don't worry about it. Or we can look at GPIQ doing it at 60% long-term and 40% short-term. So that is a possibility with your taxes. Now, there are obviously some risks to consider, and when we're looking at covered call ETFs, the risks are probably a little similar on all of these covered call ETFs. First of all, GPIQ is focused mostly on technology, and it's focused on kind of the Nasdaq 100. So if technology were to make a major dip, well, you're going to see this covered call ETF make a major dip as well. Now, the second reason is going to be capped upside. GPIQ is selling covered calls of 25 to 50% of their portfolio, allowing the 50% to kind of go up, but it's got a capped upside. It's not just doing a QQQ. So if QQQ goes up 12 or 15%, GPIQ is not going to go up that way. And so it's going to have some of that upside capped. Now, that may not be a problem for most people because if we're looking at GPIQ, we're looking at income. We're looking at a little bit of price appreciation, not like a QQQ. If we wanted a price appreciation of QQQ, we would just buy QQQ. Now, the third one is options can be a little complex, and so that could be something that you may not be easy with, but this is actively managed, so we're allowing the professionals to do the job for us and not worrying about options in our own selves. Now, the bottom line is GPIQ is a great covered call ETF. If you're looking for some income and you're looking to see which one you could buy and hold, well, GPIQ does a great job. I mean, it's got a 10% yield. It's got a 56.56 total return since its inception, which is amazing, which is beating out JEPQ and it's beating out QQQI. Now, QQQI is a little bit newer, but if we compare the two, GPIQ is winning in the total return kind of marathon. So that's a good news to you. Now, you're not having as much capped upside as some other covered call ETFs, and you're getting a good amount of premium because that other 50% is selling covered calls at the money options. So there's some great pros and cons to this ETF. So if you're looking for a good covered call ETF to add to a income portfolio, GPIQ should be one you should consider and look into. Now, let me know in the comments which one do you like the best, and if you like this video, make sure to check out our video up here about 3 of the best covered call ETFs that you can buy and hold today. And I'll see you in our next video.